all my life, been grinding all my life. Sacrifice, hustle paid the price. Want a slice, got to roll the dice. That's why all my life, I've been grinding all my life. Look, all my life, been grinding all my life. Sacrifice, hustle paid the price. Want a slice, got to roll the dice. That's why all my life, I've been grinding all.
So let's unmute. We got to remember unmute. I've forgotten that a few times this week. How's it going, everyone? End of the week. We're finally there. So thought let's do another one before the end of the week. We got some news to cover. There's plenty of things that have been happening. Always plenty of things that are happening. And you know, both Australian market and US market, and we got to cover it. You know, we're out here. We got to do this. This is the Market Unpacked. So I thought I'd kick it off with a bit of news that we heard from the US a couple of days ago, I think it was now, with respect to Spotify. So Joe Rogan has actually came out and he said that he'll be exclusively streaming the Joe Rogan podcast on Spotify, which is a massive deal. You know, so many people watch the Joe Rogan Experience, the listen to the podcast, and watch the YouTube videos, and he's now partnering up with Spotify, which is a huge win for Spotify. Like, it's just going to be massive, a lucrative deal for them, really, with the number of viewers that they'll potentially get towards. Sorry, just getting a call at the moment. We're back. So yeah, with just the number of people that Spotify will put on board because of this is a really valuable deal to them. So exclusive deal, and we'll see the podcast, the Joe Rogan Experience, disappear from all other platforms. So that's Apple Music, YouTube, everywhere else. And the multi-year deal is believed to be worth $100 million, according to Wall Street Journal. Rogan's podcast, which is one of the most popular, I think it's the second most popular podcast on Apple Music, will arrive on the streaming giant on the 1st of September. And it will remain free. It will be the exact same show. It's just a licensing deal, so Spotify won't have any creative control over the show. Now, I'm looking at this news, and Joe Rogan also said that later on, you know, the previous videos will be still available on YouTube, but eventually it'll all be only on Spotify. Now, I see that news and I start to think, is this something I should be looking at for Spotify and assessing it as a stock with huge upwards potential? Is it something that I should be adding to my portfolio? You know, Spotify is one of the biggest music streamers, and it's slowly been breaking into the podcast market. But, you know, it's got stiff competition with Apple Music and other streaming platforms like YouTube. So making a deal like this is huge for Spotify to be able to get a whole bunch of new viewers onto their platform. And I think it may be a real, you know, a successful step towards expanding their podcast segment of the business, because it's never really been as huge as other platforms. So, you know, and the last thing is this a potential shift for Spotify to go in towards videos, into actual video streaming and not just music and audio podcasts alone? And if that was to happen, if they're going to actually branch out into that through this, because we know that Joe Rogan doesn't just do his audio podcast, he puts out the YouTube clips as well. So if this is going to be exclusively Spotify, and Joe Rogan still wants to produce the video side of the content, then Spotify will surely have to create a platform that will be able to cater to that. So if that is the direction that Spotify will take, then we very much may see a stream wars between, the giants with Apple and YouTube. And if Spotify does break into the video market, it could be some serious competition to YouTube. And there's no real, you don't really know where that could end up for Spotify. Like a whole new business segment could be added towards it. And so I thought I'll take a look at Spotify stock. What has it been doing? Assess it compared to its peers. Is it something that is valuable? Is it fairly priced at its current price with further growth ahead of it? So looking at this here, it's pretty much at an all-time high at the moment, with running up on this news. And the company isn't currently profitable. If we jump on over to our little Simply Wall Street assessment here, and we just go over to here, so we can see that it did have a short period of profitability before dipping back down, and sort of just hovering around break-even territory at the moment. But if revenue continues to grow at the huge rate that it has been, and this business is something that you can really leverage with it being mobile based. The product is something that it's a service in which doesn't require a huge amount of additional costs in order to maintain it. You've got the servers hosting the music. You've got to pay your staff for being able to implement updates to the app and any bug fixes. But in the long run, this could be a hugely profitable company, and particularly if it's going to add additional segments to the business. So I'm just going to look at this one back here, and we can see that the market cap is nearly $36 billion. So Spotify currently has about a $36 billion market cap. It's headquartered in Sweden, but it's a US listed stock, right? But if we compare the $36 billion market cap of Spotify to the likes of YouTube. Now, YouTube is a part of Alphabet, which is the parent company of Google. But there has been estimates that if YouTube was to be separated out to its own business, there is an evaluation for what that would be like. So keep in mind, Spotify as it is, audio streaming only at the moment, market cap of 36 billion, right? When we jump over here, YouTube estimate the evaluation of $200 billion alone for YouTube as a business. If you were to take YouTube as its own business and separate it from Alphabet and Google, you'd have a $200 billion business alone. So if Spotify can really break into that video market, which YouTube is in, this market cap could easily be at least 100 billion, at least, at minimum. And that's, a 3x of the money. And I'm really interested in Spotify and its platform. It's the digital revolution of record labels and the ownership of music. And record labels have been in place for a long time. They take a huge chunk out of the revenues for artists, and it's an old business model. It's something that's been around for a long time, and there's the inefficiencies in it because every record label knows that if they're going to be taking a risk on many different artists and not knowing who will really take off, they have to factor that margin into all their royalties on the music that they publish. because, you know, for every one artist that really blows up and makes the record label tens of millions of dollars, there's hundreds of artists that, you know, may never blow up, but still the record label continues to put out their music, do the marketing and all of that, and they may only be bringing in, you know, a few thousand or, you know, $10,000 for that artist to the record label. So the record label has to factor in that risk that they take with different artists on everyone across the board. Whereas I see Spotify as that, you know, that next step in ridding the inefficiencies in the record label industry. And this is what we've seen with a lot of the tech giants, any of these tech companies that have come in and they're just huge today. You look at Amazon revolutionizing commerce and making it online easier to accessible. It's a one-stop shop, and then branching out to other areas, you know, your web hosting, all of that. Netflix, you know, they took the rental industry, the video rental industry, turned it on its head, decided that, you know, why do people have to physically go get a copy, pay a big sum of money for one rental, and then a lot of these businesses made most of their money from the actual rental fees, and Netflix turned that on its head completely and said, look, you put it on a subscription basis and digitize it, you know, put it through the internet, this thing called the internet. Why don't we utilize it for getting video out there instead of people having to get a physical copy? You know, so many businesses that have grown to be massive have revolutionized an industry that for a long time has stood still and stayed the same. Record labels have had the same business. The business structure has been, the business model has been the same for such a long time. Spotify is the one that has come in, and they're really, you know, in a bit of a balancing act at the moment. They're trying to facilitate record labels, but also they're eventually trying to become the record labels. They're trying to take the business from the record labels and be the distributor for independent artists, really. So a musician can go to Spotify directly, there's their music, boom, put it out and get paid, and you know, you haven't got a record label that's taking 60-70% of all revenue from your music or your podcast then. But what this enables Spotify to do, if their business continues to expand and they really do become the forefront of music and audio and possibly even video distribution, is what that can lead to through the platform, other areas in which they can facilitate for artists. So think merchandise. If an artist wants to sell their own merchandise, which they've independently gone and put designs to and produced, and they want to market it through a platform, well, it would make sense that the people that listen to your music largely on Spotify could then easily purchase your merchandise directly through Spotify. You know, it makes sense, and that's another business segment in which Spotify could be commission based, like take a small percentage of each purchase made through Spotify. But then also think, you know, and I thought this months ago. This was an idea that I had, but obviously never really did anything with. But the whole notion of why can't artists be sort of like a company? Companies list on the stock market and they capital raise. When they put forward a business idea, investors are willing to give them money so that then they have a chunk in the company. If they do well, they believe in the product or the service, and that takes off, then the shareholder, the person that gave them capital to begin with, makes money out of it. What if Spotify could facilitate that for new independent artists? You know, people that need money to go do their next tour, or they need new audio equipment, or they need to pay for their next recording studio. If Spotify could actually be the middleman, almost like they're the people that manage the fund in a way, so that an artist might say, I need $100,000 and this is what my worth is then, like 100 grand. And people who appreciate their music and listen to it might put in $1,000, $5,000, $10,000. They now have an equity stake in that artist. And as they grow, then they may get paid dividends, like royalties on the music as they get bigger. And this would, allow musicians to continue to, people that may never have had a chance prior, this sort of idea may give them the platform to really jump up and expand and get noticed. So Spotify could very well be that sort of platform to facilitate that. And I guess that's, for me, my own personal opinion, is like a bullish case scenario for Spotify. If they were to do all that, merchandising, they create a video platform, they start this way of actually providing capital towards independent artists, then this could be easily, another YouTube-like company where we're talking $200-300 billion. So I'm really seriously looking at Spotify at the moment as the next investment in the portfolio, because this could be, a 5 to 10x on the money invested. So I thought I'd give that news anyway to keep you updated on, potential investments. And I'm not saying to go invest in Spotify by any means. I'm saying that this is the current news. This is the direction that Spotify is heading, and this is what I think may lead to. But as always, you need to go and look into the numbers yourself. You need to read into it and see what your thoughts and opinions are on it, because at the end of the day, if you're going to invest in this company, you have to be the one that's willing to sleep easy at night. If you're not comfortable with your money being in a particular stock, then you should never invest in it to begin with. But anyway, I thought I'd give that bit of news, and it may be of use to you. And moving on from that, I thought we'd go through the weekly watch list that I put out on last weekend, the weekend that's gone. And we're up to Thursday, so US market Thursday has reported, and I didn't get this one too well. I didn't get a lot of these right. So we'll just go through and we'll compare what my sentiment was compared to how they actually perform, and see how it actually turned out. I think it's valuable, because if I'm going to put these watch lists out, I think it's valuable to anyone that's going to look at it to actually see how the real results panned out. If you may have had the same sentiment, then you're sort of shown, well, based on that opinion, you were wrong or you were right. So we'll go through these. So Medtronic reported before open, and I was long on that stock, and we'll just jump over here. So they reported, and they said they reported that it was a miss on earnings by 17 cents. They reported 58 cents earnings per share, and missed by 17. Revenue of $6 billion, which it was a decrease of 26.4% year over year, and missed by $100 million compared to estimates. So Medtronic really didn't do too well at all compared to estimates. And we can see as a result, the stock traded down through the trading day. It sort of jumped up a little bit, but if you look at the 5-day chart here, it's a bit more prevalent. You can see a little bit easier that actually fell nearly 3% on that news. So Medtronic got that one wrong, wasn't on the ball at all. But that happens, you know. You're not going to get them all right, and that's why you never look at something like this, or you never look at anyone who's got a certain sentiment towards a stock and just run with it. You know, no one knows with 100% confidence that a stock is going to go up or down. And if they say that they do, they're lying, or they have inside knowledge. And then if they have inside knowledge and you're trading on that, then there's bigger issues at hand. But yeah, so we got NVIDIA, and I was long on that one as well, and it didn't do too badly. So we had EPS of it beat EPS $1.80, beat it by 12 cents, and revenue of $3.08 billion, which was an increase of nearly 40% year over year, and a beat of $80 million. So the estimate was $3 billion flat, and they got reported revenue of $3.08 billion. And the shares traded up on that news as they would. It was, actually, it says that it traded up here, but if we jump over to here, they're actually down for the day. It may have jumped up early in trade and then fell. I think that's what we're seeing. It jumped up here, but this was reported before. This was reported after close. So they might be saying that it's up actually after close. So we'll see the full effect, these shares, we'll see the full effect of their earnings reporting actually tonight, because they reported after close last night or this morning. So for NVIDIA and these other ones, see this trading was actually before the earnings report was released. So it was trading down before the market was aware, and then the report gets released after close. And so you could say that on the earnings reporting, it's actually down, and we can see the pre-market figure here. So it's flat basically. And I'm not too surprised by that, because we've actually seen a huge run up, which this was before the huge crash. We saw NVIDIA shares at $315 and it fell, and now we're actually above those pre-crash levels. It's actually had nearly an 80% rally. So I think a lot of the beat in its numbers, the outperformance, has already been factored into the price, and we may not see a big jump in trading tonight because of that. So I was long on that one, when really it's probably turned out to be more flat, I would say. The next one, Intuit, which is like a accounting software sort of provider, I'm pretty sure. Yeah, business and financial software company. They reported EPS earnings beat of 1 cent, so it's barely a beat, really. It's in line with expectations, of $4.49, and revenue of $3 billion, which was in line as well. So I was pretty much on the money with that one, saying it's flat, because their figures are flat compared to estimates. There's no beat, there's no miss. It's pretty much just in line. And I would say that we'll expect to see this stock trade pretty flat tonight. Maybe fall a little bit, but its actual reporting figures pretty flat. And we've got Splunk as well. I went long on that one. Splunk, it was a beat by 1 cent, so once again pretty much in line with expectations. A loss of 56 cents per share, and their revenue of $343 million, which they missed by 9.53. So they missed on the revenue side of that one. And I actually haven't got the Splunk stock. I didn't even pull the Splunk stock up. Got to get on top of the game. That is not how you spell Splunk. Too many Friday drinks. So Splunk, so it's trading pre-market, it's trading up 4%, which is actually quite surprising when it's pretty much a in line and a miss. There's not really a beat in there, but maybe the market was estimating I had it open over there. The market may have been estimating worse numbers out of Splunk, so that possibly is why we're seeing it trade 4% up in pre-market. And the last one, Elf Beauty, I was long on this one, and I was going to trade it. I was going to trade it this morning. I had this whole investment thesis behind it. You know, the online numbers were doing well if you look at the traffic for their online store, and they're cheap products, but you know, well renowned. A lot of people online that do the whole, you know, makeup tutorials and that seem to think that they're not too bad. You know, I thought it was going to be a really good stock to trade. I was going to trade it this morning, and I didn't wake up. I slept in, so I missed out. And if we have a look, it's up 6% pre-market. And if I had just woke up early this morning and traded it, look at that, up 10% just after market close when it reported up 10%. You live and you learn. Oh well, there's always more opportunities. But anyway, Elf Beauty, they came out with their results. I don't think that was their results. Let's go back here. Here we go. So it was a double beat from Elf. This is this is what I was expecting, a double beat. So they beat by like 50% they doubled the estimate, sorry. So they beat it by 100%. EPS of 10 cents per share, a revenue of $74.7 million, which is up 12% year over year, and they beat expectations or estimates by $7.7 million. So yeah, Elf absolutely killed it on their reporting, and we'll see them trade up tonight as a result. They're already up 6% pre-market, so they did pretty well on that one. You know, I'm just kicking myself I didn't trade it. I was going to do it on the CFDs, probably could have made a couple $100 out of it, but you know, sometimes you value that extra little bit of sleep more than a few $100. Sometimes. Anyway, so that was it for the watch list. Moving on to some more Australia-based stock market-related news. There was plenty, but we're just going to cover some as usual. Elders, which is, you know, they operate in the agricultural sector. I've mentioned it a few times previously on the live streams. I actually have it in my portfolio. They signed a partial refinance deal. So Rural Services Group, Elders, agreed partial refinancing terms for its debt facilities. This is really good for the company because it means that the $50 million 2-year commitment, it provides $50 million on a 2-year commitment, and they basically get to renegotiate the terms of the debt because the business is providing guidance that they're going to do better. So they came out with their earnings, their annual report, or it might have been a quarterly report, whatever it was, and it was really good. They, you know, profit was up like 90%, just massive, like really good growth for the company. They're saying that there's expected to be a good winter season ahead because of the rainfall, so winter crops should do well. So they're taking advantage of that positive momentum in the business in order to get a new debt package at a good rate, basically. So that was a bit of news coming out of Elders today. Some really big news for what most people would be. Most people would know Target. So anyone that's listening, this is news that I would expect would in some way affect you, because most people will know Target. Most people will have shopped at Target. So Wesfarmers, which is the business that actually owns Target, they own Officeworks, they own Bunnings, Kmart, they used to own Coles, but they demerged and sold that business off. So Wesfarmers says that they're going to basically be closing a heap of Target stores, and some of them converted to Kmart stores, while others will just close completely. So reading into this, at least 122 stores out of its 285 store network will be closed or converted to Kmart stores. 10 to 40 will be converted, and 10 to 25 will be permanently shut. And of all of its 102 small format Target country stores, so if you're anyone that lives out in the rural areas of Australia, and you have a Target there, it will shut down. Wesfarmers is just deciding that all Targets in all those Target country stores will shut down or be converted to a small format Kmart. So there'll no longer be a Target there. You may have a Kmart, or just completely removed entirely. But the number, and this is in the article, but the number of closures the number of closures could be even higher if landlords don't come to the party and carry some of the cost of converting Target stores to Kmart outlets, a few $1 million in each case. So Wesfarmers is basically saying that if a lot of the landlords that they have these arrangements with for the stores don't aren't willing to put forward some of the capital in order to make this conversion, then Wesfarmers will just say, hey, we're closing the store because it costs us, if you're not going to contribute, it's going to cost us far too much money to try to convert. It actually works out better for us if we just close the store completely. So that's where Target currently stands, or Wesfarmers on the Target business, which is a huge blow to the rural area. If a lot of those stores close, it's a big blow to the rural shoppers. But yeah, Target will be losing a lot of shops, and this is mostly because Wesfarmers has found that Target is an underperforming business out of all the businesses that they do own and have a financial interest in. And this is the sign of good management from Wesfarmers. They have to do this in order to ensure long-term profitability, and there's no point pouring money into a business that doesn't show progress towards improving. If the business has a turn down, the business is looking like it's underperforming compared to its peers, then maybe it's not worth continuing to run. So that's the Target news, and just a couple of extra little bits of news from me tonight, and with respect to the Australian share market. So Afterpay released a market announcement earlier in the week of 5 million active customers in the US, which is huge. So nearly 9 million US consumers have joined the platform, more than 1 million new US customers in the last 10 weeks. So in the last 10 weeks alone, Afterpay has onboarded 1 million US customers. So the stock market reacted fairly positively to this, because it's a sign that indeed what we've been hearing from a lot of people about the technological curve being brought forward as more people are adopting that. Like COVID-19 has sort of forced more people to progress technologically and on board onto these new innovative ways of doing things. It sort of shows that is in fact happening with Afterpay. But there also has been taken the other way as well, in that we've seen it's now 40 million jobless claims in the US, and a lot of people have drawn the conclusion that if you have 40 million jobless claims. You have a huge uptake in basically a credit provider, but without interest. You could draw a conclusion that perhaps a large percentage of your new 100 million people joining the platform are people that have just lost their job and are trying to buy something. They don't currently have the money for it. They want to break it up into payments. Afterpay is exactly that service. So you could say a large portion of that 100 million new customers could potentially be bad debt. They could be onboarding a lot of, providing credit to a lot of people that can't repay it. And I've seen other people on Twitter, such as this account here, where he says, to be honest, only signing up 1 million out of the 30 million newly made unemployed is piss poor for the world's leading payday lender. The algo must have been showing restraint. So, and there's, depending on what side of the fence you sit, there's some truth in that as well. You could say there's 30, and it's now 40 million people that are in a prime circumstance for the use of a buy now, pay later provider, for only 1 million people to be on board in the last 10 weeks, out of 40 million people that are prime candidates for it. Maybe that's pretty poor, if you're not converting all those, a larger portion of those people onto your service, which is somewhat catered towards people who don't have that upfront money. Then maybe you're not doing actually that well. But I currently hold shares in Afterpay as well. I think it's fairly good. I think these numbers are good. From an overall view, it shows that there's still growth in and penetration within the US market. But we will only see with time as to how much of that uptake is actually going to turn out to be bad debt, which isn't good for the Afterpay business model. And lastly, a bit of news out of DroneShield, which is another company that I own shares in, and maybe I'm a little bit biased with what I cover, but I find this news just stands out to me. So if you do own shares in other companies and there's news coming out, let me know, put it forward to me, because I have watch lists and notifications mostly for stocks that I'm following, I'm interested in buying, or I already have invested into. So if there's news that comes out that I'm not covering and you think I should be covering, let me know. Message me, and I will make sure that if it is indeed pretty interesting, I'll cover it. But anyway, DroneShield came out and they said that they were chosen by the European Union Police. Now, DroneShield, they provide products in which allow defense against drones, and under all conditions, really. They have a few different product lines. They have guns that you can point towards the drone and control where make the drone land, bring the drone back to you, send the drone back to the person flying it. They also have units that can be mounted on people as a jammer, basically, to stop the drone getting any closer than, say, 1 kilometer away. Those similar sort of units can be mounted on vehicles, so the drones can't be just strapped with a bomb and flown into a vehicle. So the same sort of hardware, they have products mounted to vehicles, and they also have portable standalone units for large gatherings. So DroneShield was actually used at the I think it was the Commonwealth Games, I believe it was, at the Gold Coast, where their sentry towers were put in place, and those towers basically alert anyone monitoring them to whether a drone is in the vicinity, but also stopping them from entering the grounds to target large masses of people. So this contract win is really big for Drone Shield, and I think they outlined that it's the first of its kind. The first framework rollout of counter drone equipment by any government customer anywhere in the world, which is huge. It's basically an acknowledgement by a government somewhere in the world for the first time saying, look, drones are a concern. They should be a concern, and we should be preemptive towards them. We should be implementing something to protect the police force and provide some means of controlling a drone in a circumstance where the police might be deployed to combat a situation where a drone is being used in a dangerous manner. Justin with the comment, isn't it dangerous to shoot down in-flight drones? Well, the thing is with Drone Shield, it's not actually like a gun per se. It's not just a simple loadable rifle. You aim and you shoot, and a projectile comes out and you hope to hit it. It's actually using some form of transmission and not a physical projectile that interrupts the signal and allows the user of that drone gun to take control of the drone. And once they've done that, they can either control it to land in a specific location with Drone Shield provided controls, which that may be if it's a dangerous, if there's bombs or anything like that attached to it, they could fly it off to an area where there's less people, less population density, or if it's been assessed and it's just a drone simply and they want to land it safely, they could bring it to them so they can then look at the serial number on it and possibly track it back to the person who purchased it in order to then go find that person and charge them or make any inquiries about the situation with them. So it's not actually a physical gun. It looks like a gun. It's shaped like a gun, and there's this picture here. Probably not like any other gun you've ever seen before, though. It's something like out of a sci-fi movie, really. And this, this blade shape on this gun is where it's basically got all its equipment, where the transmission is sent through it. I'm not too sure what it actually uses. I'm not sure if it's like radio frequency or something else. I imagine it is, but it's actually using a frequency range in order to take control between the gun and the drone itself. So hopefully that makes sense. I don't want people thinking that Drone Shield are just out here selling guns to shoot down stuff. Drone Shield now selling AK-47s. That's not the case. But yeah, so they signed up. They won their competitive tender for the Drone Gun Tactical, which is this product that this person is holding here, and it's selected by the European Union police forces, and they'll be deployed, and it said somewhere here, or maybe I just keep reading through this, under the framework agreement, Drone Gun Tactical is expected to be rolled out across a range of police units across European Union, while the agreement does not specify minimum purchase quantities. So they're not yet saying a specific minimum number of units that will be purchased. So they're not going to tag a specific amount of revenue that this deal is going to provide. So they do not specify minimum purchase quantities. Drone Shield expects this agreement to produce material periodic sales over an extended period of time, which is really good. That's what you want to hear. It's better having a deal that has incremental sales over a prolonged duration than just one hit and done, because it makes for better cash flow management if you continually have a regular income of cash flow than just to have one lump sum and that's it. And then you have to go find and win another contract. So just continuing to read on for this. Orders commencing this quarter. So this is going to take off really quickly. It's not something that they're saying, look, cool, we've won this, great, but we're not actually going to see any revenue from this for another year. They're going to actually start commencing this quarter, so really soon, straight away basically. Further, the company expects this framework to be a platform for sales of its other products, which I was mentioning previously, such as RF Patrol and its vehicle and fixed site products to EU police departments. So this deal, originally it's just the drone gun tactical, but they very much well find that if this works really well, why not use the other products to ensure safety for the vehicles as well, or ensure safety for potentially even police stations if they put the Sentry fixed location products up on the police stations themselves to stop drones just flying straight into the police stations. So they can definitely grow quite dramatically from this one win alone. This really is a big deal for the company. And the CEO goes on to say, it's really exciting. It's the first of its kind. It's substantial for the company, and they won they got UK government certification last year, and that actually allowed them to be able to compete in this competitive tender process, which they've now won. But he says this win of the competitive tender by Drone Shield illustrates that security is at the forefront of governments globally, as well as the fact that after a brief interruption caused by COVID crisis, global procurement processes have resumed. And I think the first part of that sentence is really key. Governments will have to start paying more attention to the risks that are posed by drones. Drones that people can go buy at any shop. Even the smaller ones, right up to the much larger quadcopters and that sort of thing. They all pose a risk to densely populated events. Sports games, entertainment. Anything, crowded areas, political events where there's a large gathering. We've seen drones used for such things in the past. We saw the drone attacks on the Saudi Aramco oil refinery, and how that those drones blew up and had a huge created a huge amount of damage to that location. And we also saw an attempt to attack or cause some harm at a Venezuela political event. I think it was probably 6 to 12 months ago. But there's a lot of unrest in Venezuela, and there was a drone that was flown over the crowd during a large political event, and that drone luckily was detonated in the sky above people and didn't actually get a chance to get down amongst people. Otherwise, we could have been talking about people that had lost their lives. So governments definitely will have to start paying more attention to this. It's a huge risk, and I think Drone Shield is really in a great position with the technology that they have and the amount of experience they have in this in the market. And that news, when it came out, we saw a rise in the stock of at one point it was 71%, and it came down to about 61% at the end of the day, and today it fell about 3%, but still up at 17 cents per share when it was previously trading around 10 cents per share. So yeah, massive news coming out of Drone Shield, and I think we will probably see more of that sort of news coming from them in the future. So guys, that's about it for all the news that I have for the week. I hope that I summarized a lot of it. There's plenty more out there, and I'm just here to put together a few little key snippets as best I can. But if you want to see more news, go like the Twitter page. I'm always posting stuff on there, much more commentary around other broader issues, political, economically based. I put a lot more of my own say on there as well. If you want to see more opportunities within the stock market, go join the private Discord group. We have a good community in there of people that chat, and we all talk about what plays that we're making, what we're looking at, and communicate news that's happening in the stock market. But other than that, guys, cheers for sticking around on your Friday night and taking the time to give it a listen, and I'll catch you next week. Have a great weekend. See ya. Bye.